Greetings and welcome to the Sharesoc Budget 2024 coverage. Over the next hour, we'll be asking what the new Labour government's first budget in 14 years means for our investor audience. Let me introduce you to our panelists. We're delighted to be joined by Neil Shah, Director of Content and Strategy at Edison Group, Stephen English, Investment Manager at Stellar Asset Management, the inheritance tax specialists. To give us the retail investor perspective, we're joined by Twin Peaks podcast host Henry Viola Eyre, and finally Paul Greenwood is a Sharesoc member and former actuary I do apologise, retired actuary who will guide us through the pensions maze. Next, it's our disclaimer slide, which you can read at your leisure. The key point to make here is that tonight's discussion shouldn't be taken as financial advice, as we aren't authorised to give it. As sophisticated investors, one and all, I'm sure you understand that very well. Okay, here we go. The budget summary for 2024. Just a quick reminder of the key changes introduced in Labour's first budget for 14 years. This stands out to be the largest tax-raising budget in living memory, with Rachel Reeves announcing 40 billion worth of tax increases for employers and wealthier people in the main to partially pay for £70 billion in increased spending. And it came as a little bit of a surprise. The key tax-raising measure was an increase in employers' national insurance, which will rise 1.2% to 15% from April next year, backed by an almost 7% rise to the minimum wage. In a move affecting investors, the low rate of capital gains tax will rise from 10% to 18%, and the higher rate from 20% to 24% from the day of the budget. So that's a change that has already taken place. And it's in line with capital gains tax on property, which remains at 24%. Pensions are to be brought within inheritance tax from 2027, something which will be of great interest to many of you, I'm sure. It's a move which will affect the estates of many wealthy pensioners and may lead to double taxation. More of that later. The change doesn't affect spouses and civil partners, though, so that's a very clear distinction to make. It's more about intergenerational inheritance for single people. Now, moving on, previously exempt AIM shares will now be subject to 20% inheritance tax. That affects most people on this webinar. And for property investors, stamp duty surcharge on buy-to-let and second homes will increase by 2% to 5%. And likewise, that probably affects quite a few of you. Now, that's it for our introduction. Topics for investors next. Let's welcome our panel. Many thanks for joining us to make sense of what was an undeniably bold tax and spend budget. What did each of you make of it? What were the highlights? What were the potential flaws? Okay, well done. You're back from your meeting, Neil. I'm delighted to see you here with us. You've got many clients in the UK equity space. I presume you've just been meeting one, in fact. What did you and they make of the budget?
Thanks, Donald. I think generally a positive reaction to the budget. I mean, I think in part because actually there's quite a lot of fear factor baked in ahead of the budget. If you didn't see it, I did do a webinar with Gervais Williams on the impact of the budget, and he was probably the most bullish I've seen him for a while. Now, what's driving that? Firstly, I think the fear factor isn't as bad. So a lot of the sort of muted sort of changes haven't come through. Yes, AIM is subject to inheritance tax, but there still is a tax break in there compared to some other asset classes. You haven't seen sweeping sort of reforms on capital gains. There's modest changes there. So I think there was generally sort of a mood of optimism around that. Secondly, when you're looking at the changes on pensions being brought into the IHT NEC, there is a feeling that there is going to be some asset allocation decisions in the years ahead. In particular, AIM still provides more of a shelter effectively from IHT than pensions do. So you might see some asset allocation changes there. Broadly speaking, from a macro perspective, this budget is, if you looked at the numbers, patchy growth, I guess, is for the years ahead is what is expected, accompanied by perhaps a higher inflation expectation. So rates are probably going to be higher as a result of this budget than previously anticipated. The UK, the UK typically has more capital intensive industries, more cash flowing industries. And so again, if you're in an environment where actually, that capital is costing you more, the fact that you've already got that capital starts to prove more attractive for investors. Dividends and cash flows start to prove more attractive for investors. And a tougher growth environment means that you've got to work harder for growth. And so actually smaller companies where it's easier for them to grow is going to lead to some focus. So on the whole, I think it's been seen as a positive for equities. The other thing is that we're probably seeing a little bit of switching out of bonds towards equities because of the high inflation expectations. You're probably going to see some more allocations effectively into the equity side. The final thing I would say is that the if you look at the actual performance of the markets on the day, it's a pretty good indication, I think, of the mood of the investors, which is FTSE 100 was up, FTSE 250 was up more, and AIM outshone the lot of those indexes. So I think it's as a budget that benefits smaller companies on the whole, from an asset allocation perspective, and has been seen as a positive for equity markets.
Okay, Neil, that's a useful summary. Thank you very much. Stephen, you're an inheritance tax specialist. What were the highlights and potential flaws from the Stellar team's perspective?
The highlights that it's over. I think that's it, highlight wise. Speak ad nauseum now about the downside. I'm not sure Labour quite had this mandate for the budget that they delivered. They pre-election, it was all about a growth agenda, and they campaigned on a growth ticket, and this was definitely not a growth budget. And in fact, the OBRs revised down their growth expectations over the entire 5-year period, despite the increased spending, which is pretty significant. I think that really tells you everything you need to know about productivity in the public sector versus private sector. They are roughly the same size now. If you go back to the 90s, the private sector was twice the size of the public sector. And if you look at productivity gains, there has been pretty reasonable gains since 2000 in the private sector, but very, very modest productivity gains in the public sector. So what this budget is a repatriation from the productive to the unproductive, because there's no incentive in the public sector to become more productive. That's just not their raison d'etre, where it absolutely is for business. So there's a real risk of crowding out private investment. In my Q3 fact sheet for the AIM IHT service, I led with the title "The Goose is Plucked" with a P. That was a nod to King Louis XIV's finance chap, where he said the taxation consists of plucking the most feathers from the goose with the least amount of hissing. Well, the poor goose now is prematurely bald. I think he's going to have to go to Turkey to get a feather transplant. It was a really interesting budget, specifically on AIM. What we're deeply unhappy with is, yes, we've still got some relief. It's 20% from April 26 rather than 0%. But for reasons we can't fathom, and we are lobbying very, very hard as we speak, we are not included in the £1 million threshold. AIM have been carved out, almost like a second-class business relief citizen now, and in that respect has diluted the appeal of AIM shares pretty significantly. So the government is implicitly favouring private capital preservation schemes. How many more care homes do we need? How many more wind turbines do we need? Versus growth capital, of which the UK market is starved. We're really struggling with the rationale for that.
Okay, so slightly gloomy from you there, Stephen. Henry, welcome, Henry. From the retail investor perspective, were investors expecting the worst, and is that how it turned out?
I think most retail investors were expecting the sky to fall in completely after the budget. I mean, some of the headlines were saying that, the tax breaks on ISAs were going to be scrapped completely. Capital gains taxes were going to be hiked up to 40%. I think people were, in some quarters, genuinely fearing the apocalypse. And as it turns out, it didn't actually transpire that much of that happened. So although, national insurance contributions have gone up and tax rates have gone up, I think from a retail perspective, we still do have an economy. We are still one of the largest economies in the world. I think we still do have opportunities in the market. And I take what Stephen said there about the public sector not having a raison d'etre for productivity. But at some point, you do need to fund schools and hospitals and roads and the like. And I think there's a chance that this Labour government may well start to fund more of that than we've had over the last 14 years. And so hopefully that will boost growth rates, even if initial signs are that the OBR is not too optimistic about that.
I presume you, along with other UK retail investors, Gervais Williams included, you actually see the UK market as remaining relatively cheap in comparison to other worldwide markets.
Oh, absolutely. I mean, if you compare us to America, America's at absolutely nosebleed valuations. I think there's huge political risk around China. And so the question is, where do you go? I mean, there's plenty of countries in the world, but in terms of the attractiveness of the UK regime, I think there's lots to like about the UK. We have got some headwinds. We've had some headwinds, but certainly I don't think this was a sell everything and move to cash budget.
Okay, fantastic. Henry, that's great. Over to you, Paul. From a pensions point of view, what did you make of the budget?
Well, the big happy news must be that the main pension tax reliefs actually remain in place, because, I mean, there was rumours about the lump sum being cut back and having a limit placed on it, or relief of 40% no longer being available and being chopped back to a basic overall basic rate or a flat rate of 30%. And none of that happened. So the only hit the pension scheme got was inclusion of inheritance tax, which really is a removal of a loophole that happened by accident, I would put it, because historically there was been very few post-retirement death benefits under pension schemes as they stood 20, 35 years ago. And when George Osborne introduced pension freedoms and drawdown, that meant that people were left with monies in schemes. They decided that could be a death benefit subject to income tax. And naturally, as occupational and private sector pension schemes have been paid death benefits under discretionary trust, they fell outside the inheritance tax regime, which created the loophole this budget has closed.
Okay, Paul, more on that specifically from you later. That's lovely. That sets the scene very nicely. Thank you, everyone. Now, let's take a macro perspective. Neil, how does this affect investing in UK stocks? What are the things we should be aware of? If you're a thematic investor, have the themes changed?
Yeah.
What are the specifics that we should be looking at now? What has changed?
So I mean, you can't take it in isolation. You have to take it in account with the other big event of the week, which is the US election. Let's roll back. Before the budget and the fear around the budget, you had been seeing diversification out of where a lot of people made their money, which is in large US tech names. And when we are talking to US investors, the sense we get is that they are looking at other places to put money to work, because they do think that the growth environment is going to be more challenged going forward. They do think that there's inflation risks ahead. And hence, the margin of safety of somewhere where valuations are low rather than high is attractive. Anything that's paying dividends is attractive. And you had seen flows coming into the UK market after many, many years of outflows. You'd suddenly started to see indications that the UK market was starting to turn a corner. Unfortunately, you had the budget ahead and all the uncertainty of the budget. And that the October month saw outflows. I think if you listen to some of the commentary coming out of the execution-only platforms, people liquidating their ISAs, their share ISAs into cash ahead of the budget, and so it put quite a lot of pressure on the UK market. I think that's going to start reversing, and I think it'll be reverse sooner than a lot of people anticipate. If you think what is going to happen in the US, I suspect it's going to be a high spending. There's going to be Trump is going to spend, and that's going to put pressure effectively on rates. And I think that that's going to continue to limit the appeal effectively of a lot of those sort of US stocks. And you're going to start to see that diversification play coming into the UK. So attractions of the UK are valuations are attractive. A lot of the companies here are established and sort of cash flowing and paying dividends, and that's something which I think appeals. Sector-wise, I think the places I would start looking at are, of course, anything that's got tailwinds from the budget. So there is more spending on the NHS. Aware that there are plays to take a look at there. A number of healthcare services companies were sort of treading water ahead of the budget because they couldn't get commitments on particular programs moving forward, and I'm hopeful that those will move forward. Infrastructure continues to be a big area, I think, for exposure. Anything in the sort of the green technology, renewable technology area, I think, is also an area that will be of interest. But ultimately, it's I would be more simple than that. Good quality companies which attract on attractive valuations and are cash flowing and generating dividends will be of appeal. So I think my macro perspective is is what I said at the outset, which is that the UK should benefit from the events in the world, and what is attracting people to it is its valuations.
Great. Okay, Stephen, macro thoughts from you?
I'd echo a lot of that Neil said. If you look at the immediate 2-day reaction, the Russell 2000, which is kind of their small and mid cap index, is on nearly twice as much as their large cap Russell 1000, and I think that's already pointing to we're probably looking at a bit of a sugar rush on growth. When growth is more abundant, generally, you go into value. When growth is scarce, then you pay up for quality growth because of that scarcity factor. So that plays well to small and mid caps, not only in the US, because there's a strong correlation to global small and mid cap of US SMID outperformance. So we're well placed there. In terms of the valuations, looking at it yesterday, we have just gone to a new low versus the US. Even on a sector adjusted basis, we're at a 35% discount to US valuations. We're even at an 8% discount to Europe, notwithstanding the problems that they have. If you think we're in a bad position, do you want to be Germany or France with their political backdrop as well? And I think looking at longer term themes, anything that can be automated will be automated. So anything that plays into that. I think inflation, if you look at the 70s, everyone says it was a high inflationary decade. While true, it was very much it came in waves, and that could quite easily happen again, especially as big government now is here to stay. And from the government and here to help. Reagan said in the 9 most dangerous words known to man, but that is just the political consensus now post-COVID. Big government is the supposed solution. There's no point in bleating about it. It's just getting used to that. And now fiscal policy is now very, very political. So I do think you're going to get more volatile inflationary backdrop. If you look at the 70s, one of the best asset classes were small caps for technical reasons, one of which was the cheapness of them. And risk is primarily a function of what you pay on day one, and you're paying a very, very attractive entry price now. So by hook or by crook, value always out. It was happening through takeovers. That's gone quiet for the last couple of months going into the budget. If prices don't reset higher, then you're going to see private equity and trade buyers come back into the UK market and carry on picking off these companies on very, very attractive valuations. And these companies are often world leader in their particular niches. They just happen to find themselves listed on the London Stock Exchange. The final thing I'd say is look for companies with unfair competitive advantages. Victorian Plumbing may be one example. This isn't a recommendation by any stretch. It is a stock we hold in the portfolio. 80% of the products are own brand. That gives it a structurally higher gross margin profit pool, which it can then outspend its competitors on marketing. It spends 30% of revenues on marketing, which is seen it capture market share, and as a self-help program on operating margins. So tremendous pricing power, tremendous self-help
Great. If I could bring you in here, Henry.
Yeah, I think, a lot of the points we've made here are very sensible about changes over in the US, and perhaps some cyclical trends. I think one thing we've not touched on particularly here is changes in the gilt market. Gilts have been creeping higher and higher. Gilt yields, I should say, have been creeping higher and higher. The US is going in the same direction. And I think over the next couple of years, you're going to see a lot of companies struggling to refinance. So, in addition to watching out for companies that have perhaps got cyclical moats or structural outperformance capability, watch out for what their debt maturity profile looks like, because although they might have refinanced cheaply a couple of years ago, you could find more and more companies starting to have financing issues, especially if the US and the UK don't start to get yields under control. It's going to affect the whole market. So that's one thing I'm very, very cautious about over the next couple of years, especially considering the fact that this last budget was very much we're borrowing more and we're spending more than ever before, really.
Very good. Now let's move on to capital gains tax changes. Let's throw to Stephen. These capital gains tax changes were widely flagged. Any tax rises are generally seen as bad by investors. Could they have been worse?
Definitely could have been worse. We saw high 30s being talked about. So again, this kind of
yes, just under 40 I saw.
Yeah, alignment with more like income rates. And actually, while it feels bad because they've gone up, it's a relatively modest amount at the higher end, and there's still significantly lower than the commensurate income tax rates as well. So, and also, if you compare us to the rest of the world in terms of the wealth tax, they are still relatively low. And I appreciate this is a relative argument rather than an absolute argument. So, for the sake of 4 percentage points or something, I can't see it changing any behaviour manifestly. It just kind of, I mean, you should already be doing this, and any allowances that are available to you, make sure you are absolutely maximising them. In particular, ISA, and we touched on it as well. I'm sorry that the British ISA has been canned. I thought that was actually a good idea. But yeah, please do use those wrappers, and thankfully they weren't tinkered with. And certainly, we look at the bulk of our AIM-IXT clients. Actually, most of it is already sheltered.
I've always wondered why they didn't make those wrappers larger than 20,000, but that's just me.
Yeah, they don't want it to be too generous, even though they've been fixed at that level for quite some time. Maybe they should be indexed up.
Yeah,
Yeah, I'd agree.
I'd love that. Neil, capital gains tax. What are your thoughts?
I tend to agree that a lot less worse than feared. So I think there's a sense of relief around that, and I don't think it's going to change behaviors too much. I do think that the ISAs will come back into favor because it's getting harder and harder to shield income. So I think there's an attraction there. I do think that all of these things are marginal. So certainly some of the conversations, I'm by no means an expert around this, but I do think that when people are thinking about asset allocations as a result of marginally higher sort of capital gains tax and some of the other changes, multi-asset portfolios might be more attractive to people. And so you might see some thoughts around the sort of capital allocation side of things. Outside of that, it's going to be interesting to see what happens, I guess, at the end of this year when sort of the reforms on the pension side come through and we actually start to understand, is there going to be a mandatory allocation of pensions to UK stocks? Is that going to benefit flows, etc.? So I think the capital gains thing is a modest sort of pinch point, etc., but not going to distract people from, I think, the bigger upside that you're going to get. And there are ways of sheltering your gains effectively with the ISA wrappers, etc. So generally, I think it's not too painful.
Could you expand on that point you made there, Neil? That was really interesting. You said towards the end of the year, it may be that there's mandatory that people invest in UK stocks.
I mean, so I guess the question is that the London market for a while has been neglected, and absent in the budget was any measures to stimulate demand and support the London equity market. Before this government was elected, there was a whole program in the Mansion House reforms, etc., that were sort of advocating a series of changes. things went a little bit quiet on that front, but one of the things that is being looked at is, reforms on the pension side, and the expectation is that reporting on that's going to be done by the end of this year, and you'll get a spectrum of outcomes. One of those might be going back to, yes, all pension funds have to declare exactly how much is being allocated to UK stocks, but it might go further as to you must make a certain allocation into UK equities. So I think
Would you favour that, Neil?
would I favour it? There's an argument that there's an argument that if you're giving people a tax break for investing in pensions, and there are other reasons for those tax breaks in terms of encouraging savings and looking after your future. But if the UK government is encouraging people to put tax breaks into pensions, it would make sense that some of the allocation is going into UK equities. It's been well documented that, one of the biggest changes in terms of UK equity ownership has been the change in pension allocation. So I think maybe 25 years ago, 50% of the UK equities were held by pension funds, etc. It's down to 3% now. On the plus side, there's very little left for them to sell. So one of the arguments you hear about people calling a turn in the UK market is the biggest seller is almost at the end. But I do see a case that it's been in the press that the MP's own pension scheme has a minuscule allocation effectively to UK equities, which to me would seem contrary to supporting the UK economy.
Okay. And very briefly from you, Henry, capital gains tax. We've kind of covered most of the points.
I was going to say, I'd echo Neil to a huge extent on this. I mean, if you're going to make slightly less money from investing in shares than you were last year, are you really going to leave the money alone and just stick it in cash? I can't see retail investors piling out of the market because of these changes. And I think, again, there's a lot of headlines that have got a very strong underlying agenda of trying to scare people about this. Ultimately, it's a marginal change. I can't see a huge amount of behavioural changes coming as a result of it.
Great. Now, hold on to that thought. I'm going to turn to employers' national insurance and minimum wage rises, and I'm going to come back to you, Henry. So both of those are disincentives to hiring people. Chris Hardstaff, one of our members, asks that very question. He asks, what effects will these rises have on low wage and labour intensive sectors like hospitality, like care homes, supermarkets, even charities? Does that change your perspective on these sectors as investments, Henry?
Yeah, absolutely. I mean, it's an undeniable fact. You put national insurance contributions up, it's an extra wage on taxes. It's an extra tax on employment, I should say. That is going to disincentivize people from giving pay rises and from giving pay increases, and it will increase costs for businesses. And it's the same with the minimum wage. It will fundamentally increase costs for these sectors. Having said that, there is a flip side to this in that it will also increase income for people that work in those sectors. They likely are on minimal wages. They have low salaries. They probably spend a higher proportion of their income than people in other industries. And therefore, it could start to stimulate demand, I think, in things like consumer-facing areas, retail, consumer goods, etc. So I don't think this is as much of a catastrophe as, again, a lot of the media is making out. It is an undeniable extra tax on employment, which isn't great as a headline thing, but it should start to also increase salaries at the bottom end and therefore potentially increase demand in the domestic economy.
In amongst this potential carnage, where are the investment opportunities? There's always an upside. Where's the upside?
Well, Stephen made a really interesting point about automation. The UK is hugely inefficient in terms of productivity. We lag behind most of the other major economies in the world in terms of productivity, and part of that is a lack of investment in productive capital and automation. We just don't seem to be investing in it, and these sorts of increased costs on businesses are likely to spur more of that, which could improve profit margins generally. But also, if you think about companies like, who is it that does the automation for Waitrose, Ocado or whoever it is?
Ocado, yes,
Ocado. That sort of technology whereby you can almost remove 90% of the workforce and replace it with robotics and automation.
You might say Amazon as well.
There you go, you see. Those sorts of businesses, and there are plenty of them on the stock market, those could do very well over the next 5 years.
Great. Okay. Same question to you, Stephen.
Yeah, I've been looking at various analyst notes across the hospitality and retail sector in particular. Retail employs 10% of the total workforce. If you're looking at trying to apply screens, then obviously you look for the ones that are 100% UK focused, those with the highest wage to sales ratio, those with the lowest margins, gross in particular operating margins, and or are currently on depressed earnings. Prices are going to have to rise, and or efficiencies and cost savings are going to have to be found. Thankfully, there's a bit of a lead in time. Looking at the unmitigated impact of the notes I've seen, you're looking at between 5 and 15% cuts to earnings. But I would caveat they are unmitigated, and there's all sorts of levers for companies and management teams to pull. So I actually think in the round, you're probably looking at closer to a 3% to 5% hit to earnings on the back of the national insurance. The biggest element of it is the threshold step down from 9,100 to 5,000. That's the bulk of the cost. That alone is an extra £615 per employee. So second order effect is prices are going to have to rise undoubtedly. What I'm not sure of yet is just does this stunt wage increases next year because businesses having to absorb this huge tax on employment essentially.
And Neil, do you have anything to add to those two very good answers?
No, I think we've seen it. I mean, the pattern you want to look at is what you saw when you saw the initial sort of inflation increases coming through the market. So companies did have to absorb those costs and then worked to pass those on to their end customers, and in differing degrees were able to do so. I think a lot, Stephen mentioned that this is a stock pickers market. Gervais also brought that up, which is you're looking for high quality companies who have got a strong service track record, etc., and the ability to pass on those costs to their sort of end customers. So when you're looking at companies, do focus on that. Is what they're doing seen as something which is valuable, and is their market positioning strong enough that they can actually pass on those cost increases?
Okay, now let's stay with you, Neil. 20% tax on AIM shares is what we're going to talk about next. One of our members, Ali Huas, asks a very pertinent question. Will AIM investments held in an ISA be affected by an inheritance tax? You might as well say, will AIM investments held in a SIP be affected by inheritance tax? Now, this may not be your area of speciality, but let me ask you and see how you get on with it.
So, I mean, as far as I know, AIM stocks are subject effectively to inheritance tax, but at a lower band. I probably will have to defer to someone else if there's any. As far as I know, there's no correction for that, whether it's an ISA wrapper or not. So it's still. So I believe it is still subject to inheritance tax.
Let's throw to Paul on that one. I believe he has an answer to that. Paul Greenwood.
On the pension scheme side, I've heard the argument that AIM stocks held in trusts will be exempt, and a pension scheme is a trust, and therefore an AIM stock held in a SIP should still get the 20% relief, etc.
So 20% relief means 20% tax, though. So you and Neil concur. It will still be taxed at 20%.
Yeah, but at this stage, we haven't seen the final legislation. There's consultation out on the wider area, and we don't know what's going to be in the HMRC forms which collect this tax, etc. So I would answer yes, there's a possibility, but we're not home and dry yet.
Great. Okay, let's stay with you, Paul. Pensions and inheritance tax is our next topic. Pensions are to be dropped within the inheritance tax system from 2027. This is a slightly controversial move, a move which will affect the estates of some wealthy single older people. and may lead to double taxation. It doesn't affect spouses, let's be clear. It doesn't affect civil partners, but it does affect intergenerational inheritance. So give us a brief summary of the changes, please, Paul, and what they mean for our audience, specifically our Sharesoc audience.
The change is the exemption is removed, and the way it is basically going to operate is that the pension scheme will have to reduce take the inheritance tax off the benefits they pay out. That causes a major administrative issue in that obviously a pension scheme trustee doesn't know the size of the member's estate, and it's a consultation document out on how all this is going to be done with various quite tight time limits set as to put everything in process, i.e. the personal representative will have to tell the pension scheme within 4 weeks of death what the rest of the estate is. And one wonders how many personal representatives are actually going to be able to do that. And there'll be penalties on both the schemes and the personal representatives for not meeting time deadlines. So, as I say, it'll be interesting to see how much that gets changed as consultation goes through over the next few months.
Can I stop you there, Paul, and move us on to double taxation?
I think that phrase is unfortunate.
Okay.
Any inheritance tax is double taxation because if you think about it, it's coming from income already taxed. So a pension scheme is income.
Do you think that's fair, Paul? Given that you're an expert in this field?
Yeah, a pension scheme is income which hasn't been taxed already. So the people are putting their arms up and shouting, "This is double taxation on pension schemes." It's not. It's actually just ensuring that money passed to an estate has been taxed twice, whether it's passed through a pension scheme or passed through earnings to the individual and then to the estate.
Are they maybe talking about where then you're getting taxed at the marginal rate? So a 40% and then a 45% is an effective 67%.
Yeah. But that happens in all circumstances on income throughout the regime, doesn't it? You'll see, I mean, there's bans on income tax of marginal rate of 60% when the personal allowance gets cut back.
Paul, might you be able to discuss what options are available to people now that things have changed, now that inheritance tax encapsulates a pension? What are the options?
I've actually heard, I mean, there were some comments, certainly on budget day, that this means the people using the loophole were taking the pension asset last. They were running down everything else, and before they started taking money out of the pension scheme. And some people say, should that automatically reverse? I would actually argue individuals need to look at their own particular circumstances. If you think individuals got 3 assets, say directly held investments, an ISA probably, and the pension scheme, and they've all got in different individual tax circumstances. And they've got to remember that the ISA and the pension scheme are actually rolling up gross, where direct investments are taxed and then taxed at an increasing rate. But there's all sorts of complications. There's an actually interesting article in today's Telegraph, which points out that there's a clawback on the property 175k property allowance, which starts when the estate is over 2 million. So if somebody has a pension scheme, which actually adding the pension scheme into the overall assets can actually start that trigger and that clawback, which puts the marginal rate of income of inheritance tax up quite a bit. So I would actually argue people need to sit down and look at the various bands of all the taxes, both when they're taking income during retirement and when the inheritance tax on death, what their inheritance tax will be, and what's the best plan will actually depend on individuals' own circumstances.
Do you have any thoughts on annuities, Paul?
Annuities have fell out of favour what led to the introduction in pension freedoms in the first place. But actually, in the UK, the annuity market has been very competitive. There's 4 or 5 major companies substantially involved in it. When, as an actuary, I look at the underlying cost mark to the investment, there is not much actual profit margin in the business. The insurance companies in the business actually make profit, most of their profits from mismatching slightly the investments they hold against those liabilities. So I would say the annuity market is a market which has worked in the consumer's interests. I mean, a lot of the equity investment fundamentally, an annuity is a gilt-edged or an index-linked gilt investment, depending on what type of increases it gets. And obviously it doesn't have the higher returns by taking more risk in an equity investment. But when people get to the stage where there's not much margin in their actual income above what they actually need to live, then later on in retirement, annuities should be taken and are good value at that stage.
Excellent, Paul. Thank you so much for the answer. Now, my one last thought: the public sector workers seem to be being favoured over the private sector. That's a theme running through several of the questions we've had in. Do you have thoughts on that?
I would say that some people will say the inheritance tax pensions change has been made because the public sector didn't actually previously take advantage of it before. So they wanted to be the private sector level with them from that point of view.
Okay, very good. Now, thank you, Paul. Let's turn to a new topic: interest rates. Very conveniently, the Bank of England capped interest rates to 4.75% today, just so that our panel can answer questions on it. But they did seem to signal that interest rates will be with us higher for longer. Neil Shah.
I think that's right, and that was generally the read of the budget, which is, there's going to be more gilt issuance, there's going to be inflationary spending in the market, and that should lead to an expectation of perhaps higher rates than pre the budget. I still think that the idea of slightly modestly lower rates should be in people's minds. So I don't think you're going to get back to the days where rates are at 0.25 or 1%. But I can see arguments for rates continuing to drift down towards 4%, 3.75%. And I think that that's something that people should keep in mind over the next 2 years when positioning themselves.
More broadly, that's not just for investors. That will actually be very beneficial to the mortgage market.
Yeah, and I think there is still the theme of normalizing interest rates is something which I've seen various fund managers play, and there are different ways of playing that. So the banks, insurers, people do look at those. I mean, on the one hand, you could argue it's bad for the house builders because it's higher rates than 1%, but it's also lowering rates from today. So the house building sector might come back into focus. So I do think that it's something to bear in mind when you're thinking about sectors and asset allocation.
Yes, well, we've certainly got Persimmon, Barrett Redrow, Taylor Wimpey. There's plenty to choose from there, so lots of different ways to play that. Stephen, what are your thoughts on that?
No one can forecast interest rates, let alone me or the central bank or the OBR. But for what it's worth, it does feel like that the zero interest rate policy, ZIRP, as it was known, is consigned, thankfully, to history because it created a gross misallocation of capital globally. It's disproportionately favoured the largest and the mega caps. It's structurally impaired or undermined small caps. So any sort of normalisation there should be a good thing for particularly my wheelhouse in terms of that smaller end of the market, because small caps never tapped into low rates But it was only the Apples of the world who could issue a bond at 0.25% coupon. Some of them got away with 0% coupons. And if you think about it in mega trends, and just to set the scene, so when you had low rates and quantitative easing, the themes to play were quality and growth at any price, mega large cap, beta, so passive investments, getting your returns from an ever rising price earnings multiple, longer or deferred economic cycles, so boom bust just doesn't happen, and risk being thought of in terms of volatility. Now in a higher rate environment, because you've got the greening of the economy is very expensive, the infrastructure spend, maybe we're turning against immigration, globalization has peaked as well, onshoring, nearshoring, all these things are inherently inflationary. So now the themes you should be thinking about for this decade, or the next 10 years, will be value and growth at a reasonable price, small cap, active managers, so alpha rather than beta, getting your returns from earnings growth, not as much help from a rising PE ratio, shorter, more volatile economic cycle. So buy and hold won't work as it has done in the past. You've got to be more fleet of foot and maybe hold stocks for 1, 3, 4, 5 years and keep rotating out of them. And I think the risk this period isn't going to be volatility. It's just not generating enough returns to wash the face to cover your higher inflation rate on average.
Good answer, Stephen. Thank you. Do you see inflation being a little more baked into globally, into America, into the UK, because of for different reasons, Trump in America and the Labour government in the UK?
Yeah, I mean, I think that the general feeling is you are going to see more inflation as a result of. I mean, you have to see Trump's policies, but the expectation is he's unchecked, given that they've taken control. The Republicans also have control of the Senate. He's going to spend, and that is going to lead to inflationary pressures coming through. The UK government's spending plans will lead to inflationary pressures coming through. And then I think that the other thing to keep an eye on is, given that Trump is probably going to pursue a protectionist agenda, you're probably going to start to see stimulus out of China because they need to stimulate their domestic economy in the absence of their import markets starting to shut down or becoming more difficult. So all of it suggests that you're going to move into a more inflationary market. The offset to that is of course growth. So the fact is that we're probably going to see more volatility in the growth rate. So that will put brakes on inflation. I think we're in for a very choppy time over the next 3-5 years as a consequence of where the journey we've started this week and last.
Let's come back to that. That's such a big talking point. Henry, what are your thoughts? And let's spin in from inflation into Trump. Positives and negatives. How does it play out for investors? There'll be lots of good and bad things.
Well, I mean, it's interesting. Neil's flagged there that as the Republicans have taken the House, the Senate, and the White House all in one go,
untrammeled power.
Who knows what they're going to do with it? But interestingly, it was only probably not even a week ago, I was seeing headlines from Elon Musk, who'd been talking to him, that they wanted to trim $2 trillion out of the budget, at least $2 trillion. And, okay, this is a guy that's known for some pretty outlandish views and opinions. You could say the same thing for Trump. But I think there is an unpredictable element here in that certainly the US debt profile has changed dramatically from when Trump came into power 8 years ago to today. It's almost on a parabolic growth curve now. There's a risk that actually, well, I say a risk, but there's a possibility that somebody over there goes, hang on a minute, we need to clamp down on this, trims the budget, and they go completely in the other direction and clamp down on spending. In terms of where the interest is baked into the economy, I think certainly here in the UK, the damage is done. The price of everything. I mean, I paid £8.50 for a pint of Guinness in the pub the other night. I nearly cried. It's absolutely farcical. It was a good pint.
Mate.
You're telling me. Yeah, I mean, it's unbelievable. But these high prices are here to stay. They're not going anywhere. And whether that takes off again or not, I'm not so sure. I don't know how much the economy can bear of inflation, nearing 10%. At some point, something's going to break. So
Okay.
I'm a
So
little sanguine on it. I hope it stays where it is. It could go higher.
you're a little sanguine. Let's see what Stephen thinks. Let's spin you to Donald Trump,
It,
one of the big topics of the night, really.
yeah, it's people are talking that the debt as a percent of GDP could completely blow out under Trump. We shall see. If the market's getting concerned and everyone speaks about the bond vigilantes and the dollar is the dollar, it is the reserve currency. That's probably not going to change for another couple of decades at least. They do have that exorbitant privilege, as a French minister once called it, and they do take full advantage of that. So they can run far bigger fiscal deficit than any other country in the world. But Stein's law, something that can't go on forever, will stop eventually. The key tell will be if yields carry on rising on the 10-year, but the dollar starts to fall. And it is the dollar really that's the ultimate barometer, I think, of confidence in USA PLC and in Trump himself and his policies. And within the UK and the EU, what we need to figure out is whether we are post Brexit going to get special treatment or whether we're going to be lumped in on the tit for tat tariffs and protectionism and the barriers and the horse trading that goes along with that. I think that's to be determined. Maybe it's not helpful that our government aren't particularly friendly with Trump. I think he's suing some of the activists for lobbying for Kamala
Labour
Harris.
sent special activists to support the
Yeah,
Democrats, I believe.
yeah, not helpful, not helpful at all. But it comes back to, I think, the point Neil touched on. I think we just got to be prepared for a bit more of a volatile world. These things do go in mega cycles, but that creates opportunities at the same time. And going back to UK, if small and mid cap does outperform, well, UK small and mid cap is on a sizable discount, and that discount should close up if globally small and mid cap now are going to go on an outperformance. So just the last point, the economy is never the stock market. And, look at China, carried on growing 6-7% for a decade, and the stock market went down. So the stock market isn't the economy. It's all about the starting valuation and what is priced in. And actually, a lot of UK equities are pricing in still some sort of mild recession. So if you get a mild recession, doesn't matter because the prices should have already priced that in. If you don't get a mild recession, then the prices are going to rise because what was priced in didn't transpire. So there's a lot of negativity built in to UK, and you want that buffer. You don't want to be going into expensive stocks like the Magnificent Seven in America, which has sucked in an almighty amount of capital. When that does eventually implode like a pavlova, that capital goes to its highest and best use or where it's treated the best. That should be beneficial then for the rest of the world equities. But
Do you think Donald Trump might cause the Magnificent Seven to pop in terms of valuations?
he's not friends with some of them because they've got a bit of a libertarian bent. And apparently, if you're trying to search for his Joe Rogan podcast, you couldn't actually find it on YouTube. So they're going to have to realign themselves. There's DOJ antitrust in motion already on Meta and on Google, and we've seen this before. With Standard Oil, no one thought Standard Oil and Rockefeller's empire would be broken up until it eventually was. And I do think that the antitrust or competition authorities, as we know them, have been asleep at the wheel and have let them get too big. But that's kind of what's done is done. There's definitely been a change of emphasis, and it depends if Trump can get something out of it. But I don't think he's particularly friendly to most of them. But you've got to be careful what you wish for because there's a wealth effect because there's Americans love the stock market and they invest heavily in it. And if you get too big a crash too quickly, that would have knock-on impacts on the US consumer because a lot of their wealth would be eviscerated. So maybe be careful what you wish for.
Okay, very good point. Now back to you, Neil. You're a canny man. Let me ask you this. John Gilbert, one of our audience members, has asked a slightly different question. He says the government is busy setting up various institutions to improve value from government spending. GB Energy, those types of things, not with an enormous amount of money, not an enormous amount of funding behind them at the moment. but nevertheless, in theory, with the potential for billions. How likely are these to be successful, asks John Gilbert. And that's to you, Neil.
I mean, I think it's it, it's a noble endeavor in terms of trying to the supply side reforms that are required to try and improve productivity, performance, etc. I think are all well intentioned. History suggests that public sectors and reforms of public sectors are much, much harder than if you leave it to the private sector. And we've touched on it before, because private sectors have an incentive to improve, to generate profits, etc. So if you're asking me, I think, you know, that history would suggest that that is going to be a difficult thing to execute well, and I would sort of, you know, apply that as a risk metric if I was to judge it.
Henry, what are your thoughts on that?
Well, you know, this brings us right back to the beginning of the conversation with Stephen, doesn't it? I mean, you know, is the public sector ever going to be more productive than the private sector? It's a huge question mark, and it's a lovely idea to think that because we set up another Quango, they're going to find the magic formula for somehow making civil servants productive. Apologies if there are any civil servants on the call. Please don't come and egg my flat. But you know, on a more serious note, the whole space is riddled with inefficiencies, and I'm not entirely sure that setting up new public sector bodies is going to, you know, improve that. It's more likely to increase complexity and therefore increase costs even further. So I'm not overly optimistic about this idea that under Labour they're suddenly going to transform productivity in the public sector.
Okay, very good. Stephen, do you have anything to add to that one?
It's a good gig. David Goldstein's day rate apparently is £950 a day, so which is somewhat ironic for the Office for Value for Money. He was sat on the HS2 and the Olympics delivery. I'm not sure they were delivered terribly economically either. So marking your own homework, basically. I'm
The
not
Olympics
sure.
did rather well, though. Come on. We all enjoyed the Olympics.
We did indeed.
Okay, now we're coming to the end of the webinar. We've hit that magic witching hour of 6 o'clock. Now, personally, I'm quite committed to this one. I come from a farming community in the north of Scotland, and we're talking more marginal farmers than filthy rich ones, and they're all being asked to pay 20% inheritance tax on everything over 1 million. Now, even quite a small farm, even in the north of Scotland, can be worth £2 million. And so what my best friend is trying to do is pass it on to his family. Only one of his 3 kids is interested in farming. But how does he do that now? Because a farm is an illiquid asset. It may be worth a lot of money. It's essentially liquid. He's distraught. Who would like to pick up on that? Anybody know anything about farming on the panel?
The headlines are quite heartbreaking. You're absolutely right. You know, you work for 40, 50 years in horrendous conditions, in the rain, in the cold, for negligible margins, if anything. And then at the end of the day, the government turns around and goes, well, you've got a tax bill to pay. Actually sell the whole thing and let Amazon come and buy it off you. I don't think the government has thought this one through at all. I think it was a really daft move on their part. And I'd really, really like to see it reversed, to be honest. And I sincerely hope that they do reverse it in a future budget, because I think it's causing tremendous anguish in the farming community for very little benefit.
And although this is not a political program and we're not talking politics, the political outcomes, the political reverberations of this will go on for the next 5 years. So relative to the small amounts of money that are going to be raised, it's going to give them an awful lot of political jip.
It's a bit like the taking the winter fuel allowance off pensioners. It's going to save peanuts, but at the end of the day, you've now got Mrs. Miggins on the 6 o'clock news every night for the next 5 years complaining about it. And, you know, arguably quite rightly so. But I just don't know what they were thinking. It just seems utterly ludicrous to me.
Okay. Onto perhaps our final thought of the night: stamp duty. Stamp duty is one of those things which, although fairly insignificant in reality, it actually has an undue influence on people and on markets. So we've got a 5% surcharge on buy-to-let purchases and second homes. What does it mean for property investors? What does it mean in terms of its overall impact on the UK housing market? We're with you, Henry. What are your thoughts on that?
Well, I think if you buy a capital asset with the idea it's going to appreciate over time, you buy it for the long term. And if you're if your nose has really been put out of joint by the thought that you're going to be paying an extra few percent after this budget, hold on to the asset. If you really need to release it, I don't think this is going to devastate your plans. I may be wrong. There may be people in our audience here tonight who will be cast out onto the streets as a result of this stamp duty increase, but I find it hard to believe. And I sort of come back to this theme that I think some of the headlines are a little bit scarier than the reality of it. So I feel like the stamp duty increases are a bit of a storm in a teacup for me.
Okay, so buy-to-let, what are your thoughts on buy-to-let? It seems to be that the market's dividing up into large listed property companies, and that the individual buy-to-letter is becoming a thing of the past. What are your thoughts on that?
Yeah, again, if you want to make money in buy to let, there's money to be made in it. It's harder than it was in the 90s. I think there was a perception it was almost free money if you go back a few decades. There was work involved, but it was a lot easier to make money than it is today. Having said that, I think there are some stories floating around about people that have leveraged themselves up to an almost ludicrous degree and are now paying the price for that and aren't very happy about it. It's the risk you run if you're going to borrow too much.
There's a phrase for that. The Latin, the Romans, they're all the phrases. Caveat emptor, let the buyer beware. It's very true.
Exactly.
People have got themselves into this, and now they have to get themselves out of it.
Exactly.
Okay, Stephen, you're a man of opinions, backed up by stats. What are your thoughts on that? Oh, I'm learning that about you. Very clever man. What are your thoughts on that, Stephen?
Just ready access to Google, Donald. That's
But you
the
use
trick.
it wisely. It's how you use it, Stephen.
You'd be surprised if a 2 percentage point increase, which you could amortize over the life of the investment, would alter the maths if it didn't stack up at 5%, but did at 3%. I'd be surprised. It's just the squeeze on the amateur landlord, which had been in the crosshairs for both political parties for some time. For the life of me, I'd never want to be a landlord. I think it stopped making sense some years ago from a yield perspective, but at least you were getting away with it from a cash flow perspective. I think given the tax changes, now there's a lot of landlords who are having a negative cash flow investment now. And I was expecting maybe a bit more of an exodus than we have seen. We are invested in Property Franchise Group, second biggest estate agency chain and franchise letting agency in the UK. We always speak about this topic because they make a lot of money managing properties on behalf of landlords. And whenever they see a rental property come to the market, 9 times out of 10, it is bought by another landlord who has a portfolio of them, very likely in a corporate structure. So it's just that you can't, there's a clear direction of travel, isn't there? It's not going to get any easier, you would suspect, particularly for the amateur landlord. And thankfully, the CGT rate hasn't been jacked. So there is an opportunity maybe just to, if you think enough's enough, an exit stage left. Or if they bought it at the right time, they don't have much of a mortgage on it, then it may still make compelling sense. And they've got some lovely tenants, which is kind of key to it as well.
Very good. Now we're cracking rapidly on to the end of the program. We've got a question from a guy called Nick Cotton, a member called Nick Cotton, and he asks, has business relief changed for private companies above £1 million? Might you be able to take that, Stephen?
Yeah, it's 20%. Essentially. So you get your £1 million at 0%, and then anything above £1 million is now going to be taxed at 20%, whereas previously you had an unlimited ability to claim that relief, which perhaps was too generous. You could stick 100 million business in there and not pay any IHT on it, but now you're only getting 1 million. So absolutely, it's going to change from April 26.
Great. Okay, Stephen, let's move on to Neil. One last question from a gentleman, Chris Hardstaff again. When the Chancellor quoted projected growth and inflation figures for the coming years, he asks, are the growth figures adjusted for inflation? And as growth is always lower than inflation, one would hope so. It's kind of a statement as much as a question.
Yeah.
You can discuss, therefore. Discuss.
I'm not sure what he's trying to get at, but I mean, these are real growth, they're real growth rates, etc. Do you see you saw the sort of part of this increase was the expectation that you're going to start to see prices increase, and that is starting to come through into the growth rate, I believe. Is that what he's trying to trying to understand?
I think he is, yes. Are the growth figures adjusted for inflation, is the question.
Yeah, are they nominal or
Yeah.
real? Yeah, they're real. They're not
Yeah.
nominal. Nominal is your real plus your inflation.
Right. Gentlemen, panel, you've been absolutely fantastic. Thank you so much for sticking with us. It is almost 6:10. So I think much though it's been wonderful, it is time to bring proceedings to a halt. Thank you so much for joining us all tonight, panel.
Thanks, Donald.